realignment for the Chinese economy, for banks, for the Walt Disney Company, and for college football. This is Bloomberg Wall Street Week. I'm David Weston. This week, Rick Rieder of BlackRock on investing for no landing at all.
Even could you have a technical recession, I just think you'd have to wake people up and tell them, because you're operating at such a high level in the economy.
Deborah Lehr from the Paulson Institute on the ups and downs of U.S. relations with China.
There definitely is a reconsideration in Western economies and looking at what their relationship is economically with China.
And George Pyne of Bruin Capital on making money out of college football.
It's run by a very fragmented industry, and so it's a bit unwieldy.
For most of global Wall Street, it was a quiet week, with trading volumes down as many enjoyed some time away from their Bloomberg terminals, getting ready for what comes next. But over in Beijing, things weren't quite so quiet when new numbers came in pointing toward deflation and confirming how hard it may be to get growth back to the levels President Xi wants.
Well, China is in deflation for sure. The question is how long? And I think it's up to the policymakers. Will they react with coordinated fiscal and monetary easing?
While the United States didn't make things any easier by imposing those long-awaited outbound investment restrictions.
We will compete with them, and we should be competing with them outside this executive order, and we will cooperate with them on things like climate.
Banks had a bit of a rocky week as well, as U.S. mid-sized banks got hit with a Moody's downgrade.
Now the big super regional banks are going to be a little more tightly regulated, and that actually is a tailwind for bond investors.
And Italian banks faced a windfall profits tax that tanked their stocks before the government backed off a bit. The Walt Disney Company announced its earnings in the midst of a mid-course correction with an awful lot on the line for the world's largest entertainment company.
While linear remains highly profitable for Disney today, the trends being fueled by cord cutting are unmistakable. And, as I've stated before, we're thinking expansively and considering a variety of strategic options.
And college football continued its conference shakeup, with USC, UCLA, Oregon, and Washington all going to the Big Ten, leaving the Pac-12 out in the cold. U.S. CPI numbers came in just as predicted, with headline prices up 0.2% or 3.2% year over year, while core came down just a bit to 4.7%.
As the bond traders would say, this one was on the screws, came in right as forecast.
But those encouraging CPI numbers on Thursday ran right into higher than expected PPI numbers on Friday, even as the University of Michigan told us that inflation expectations overall continue to come down. The markets reacted to all this by going up and going down over the course of the week, ending up more down than up, with the S&P 500 down 0.3% for the week, ending at 4464, while the NASDAQ had another tough week, down 1.9%, making it the longest string of down weeks so far this year, while the yield on the 10-year ended up 12 basis points at 4.16. Here to sort it all out for us are Sonders, Charles Schwab Chief Investment Strategist, and Kristin Bitterly. She is Citi Head of North American Investors. So, Chris, let's start with you here. What did you make out of what we saw this week? There was a lot of back and forth about where inflation's going and therefore what the Fed's going to do.
Yeah, so I think what we saw this week, kind of a continuation of last week, is understanding and trying to break down what are the expectations really for rates in terms of, are rates going to be higher for longer? I think the market is also trying to assess, last week we saw this in terms of the additional supply in terms of U.S. government debt. We saw what the Bank of Japan did as well. And so trying to figure out what are the expectations for both growth and inflation. And I think there's a little bit of volatility there. So that, I think, we'll see some volatility within the month of August. But in reality, I do think, just given the conservative positioning that we've seen from investors and a lot of cash on the sidelines, a lot of flows into T-bills, a lot of flows into money market funds, that ultimately you could see the market trend higher going into year end.
So what about, from your point of view, Lizanne, higher for longer? How much higher and how much longer?
So I think that's where the disconnect to some degree still exists in terms of market expectations. Yes, the market has pushed out rate cuts into 2024, but as of now, you're looking at 5 cuts being priced in. And under a scenario, even if we continue with disinflation, where you don't see the kind of cracks in the labor market that not that the Fed is gunning for, but it's certainly in their forecasts. If the labor market stays tight and you don't see a hit to growth, it's hard to imagine what the scenario would be under which the Fed would see a green light for cutting rates versus just staying on hold. Now, you had Williams out, New York Fed President Williams out, talking about the relationship between inflation, if it continues to come down, and the fact that growth stays fairly strong and real rates start to rise. That could be a situation where the Fed says, okay, we're now getting more restrictive than we would like to be. But I still think that the bias by the Fed is to stay in pause mode until you get more of a crack in the economy, not just making a decision based on the trajectory of inflation.
Lizanne, if not a crack, are we starting to see some, at least, a loosening of the labor market?
We are. The dip in the unemployment rate actually was because you did not see an increase in labor force participation. The payroll number was weaker than expected. That's the second month in a row. Full-time jobs actually declined by almost 600,000. That's as bad as we have seen since April of 2020. We all know what was going on there. We've seen the rollover in temporary help, the big compression down in hours worked. So you do need to peel the onion back a little bit to get a sense of where there are cracks in the labor market that could start to broaden out. And I think direction is always important. As I always say, better or worse matters more than good or bad. And it's that direction in payrolls that I think is worth watching. It doesn't tend to be the case that you go into negative territory in advance of recessions.
Where are we headed for the rest of the year, would you say, Chris, from what you see right now? We had a much better first half of the year than I think most people would have expected. Are we going to keep this up?
Well, I think the one thing that the first half of the year did teach us, and we talk about this all of the time, is just the dangers of market timing. And so we started out this year defensively positioned, and we were in the camp that we would see a recession within 2023. Obviously, the data is something that has proven really resilient. I think that would be the word of the first half of the year. We saw resiliency in terms of employment. We saw resiliency in terms of earnings. I think when you actually look through, though, the index doesn't tell the full story. And so the recession that a lot of people thought was going to occur, where did we see the recession? Maybe not in the economic data, but we saw it within earnings. So in Q4 of last year, you had 7 out of 11 sectors already in a profits recession. The same was true in Q1. And in Q2, it looks like 6 out of 11 sectors are going to be in a profits recession. So this concept of a rolling recession is something that we're seeing within the market, which really begs the case for diversification.
So, Lizanne, you've talked on this program before about sort of a rolling recession. You've been talking about it for a while now, sector by sector, not overall for the economy, but sector by sector. Right. Are we seeing a version of that in the earnings right now? And let me ask you where you think we're going to end up. We have these ELVs, these equity analysts that we look at on Bloomberg, and I think they're still about 4,400 for the median for year end. Does that sound about right to you?
I don't forecast year-end price targets for the S&P. It's not something that we do. I'm just not sure it's a beneficial exercise for the benefit of what our client base is, which is individual investors. I will say, though, that the path up from here probably needs to see a stabilization in the E component of PE, because all of the gain in the market since October has been multiple expansion. You haven't had any contribution from earnings. And I think Kristin's absolutely right that you've got to look at the details of what's going on beyond the index level. That's important in terms of what the real story is that the market is telling about the macro picture. It's important in terms of valuation, too, particularly the necessity of taking out the Magnificent Seven or the Grade 8 or whatever fun words you want to use to describe what had been a very, very top-heavy market, at least into the beginning of June. And I think the sectoral or rolling recession thesis is likely to persist, at least in the near term. And to me, I think the best way to think about best case scenario is not soft landing versus recession, but a continuation of the roll through, whereby assuming we start to see services get hit, you've got offsetting stability and or maybe recovery in those segments of the economy that already had their recessions, like housing related, manufacturing, even some areas within the consumer goods side of the economy.
Okay, let me just ask one last question, Chris, of you. As thus far, the earnings have come in better than was expected. How much of that's pricing power? How much of it is cutting costs? How much top line?
It is a great question, because I think what we've seen this quarter is when you look at the overall percentage of S&P 500 companies that are beating earnings expectations, it's north of 70%, with only 13% completely missing. But when you look at top line revenue, that's where we're starting to see the impact of disinflation. That's where we're seeing top line revenue really come down. So that's only 59% of companies are beating top line revenue estimates, while close to 22% are missing. And so this idea, what does that mean to me? That really means that we're in a slowing growth type environment. So soft landing, no landing, hard landing. What I do think is going into the second half of the year, I think earnings expectations are still a little high. I think we are going to see, in a higher interest rate environment, you are going to see continued pressure, the rolling recession that we discussed. But I think some of those expectations should probably come down for the second half.
Liz Ann Sonders and Kristin Bitterly will be staying with us as we turn to the plight of those U.S. banks hit with a Moody's downgrade this week. That's next on Wall Street Week on Bloomberg.
We want the strongest banking industry. Our banking industry has better returns, has better things. But on the other hand, our multiples are half or less than the S&P multiples. There's a reason for that, which is investors are saying, wait a second, if the capital demands don't stop, we aren't sure that we can continue to invest. So there's a little bit of a countervail here that people have to pay attention to.
That was Bank of America CEO Brian Moynihan on Bloomberg just last Thursday, telling us about the effects of increased capital requirements on banks like his. Still with us are Liz Ann Sonders of Charles Schwab and Kristin Bitterly of Citi. So, Liz Ann, let me start with you. I know you don't really recommend investing based on sectors. You really rely on factors. But tell us about the banks. What do you think about the banks right now?
Well, it's been a unique rally since the October lows. If you use the simple definition of plus 20%, you're in a bull market without really any participation on the part of the banks, which is unusual. And I think for sustainability in a move higher, you're going to need some participation. Obviously, there's also been that bifurcation between the larger banks that came through the banking, I'll use Jamie Dimon's word, incident in March, in much better shape than the smaller regional banks. And you have the kind of double or triple whammy in the case of the smaller and regional banks with the recent downgrade, the fact that you've had the deposit flight, and just concerns about commercial real estate, which the exposure within the regional and smaller banks is much higher to commercial real estate and the woes in the office side than the large banks. So we're not out of the woods yet, but I think the waves from the March problems have clearly died down.
Chris, what about from your point of view? We did have that Moody's downgrade on some smaller and regional banks here. And they do have, as Liz Ann just said, they've got an issue. They have to pay more for deposits than they used to pay before. And there is the commercial real estate issue lurking out there that we're told is more of an issue for regional banks. How big a problem is it?
Yeah, so I think there's a couple of things to look at when it comes to the regional banks that are just, and it's a question around the underlying strategy, because I don't think you can look at all of the banks in the same way, but you certainly can delineate between the large GSIB banks versus the regional banks. And it's a question around, so one, what is really pressure on profitability? So we were talking about capital requirements in Brian Moynihan's comments, but then looking to even just flows away from deposits into T-bills with the very attractive yield and money market funds, that puts pressure in terms of profitability. And then if we break down the commercial real estate market, so banks overall, so looking across the entire sector, are about 54% of that market. And then you have about 70% within that are the smaller regional banks. And so when we look into if we're in a higher interest rate environment for longer, if we go into 2024, this is something that could put pressure, especially on those banks that have high levels of exposure to that sector. And one last last comment, it's not just all commercial real estate. It really is a function of we have to delineate both regionally as well as within that space where you're looking to areas, really it's office space more than anything else.
Liz, and I wonder from your point of view, there is the issue for the group of banks and whether you invest in their stocks or not. But there's also the larger question about the growth for the economy. I mean, can we grow the economy the way we need to really support the stock market, for example, if the banks don't feel they can lend as much?
Well, that goes back to sort of the classics of what happens when you go through an economic cycle. When you have tighter monetary policy via a Fed hiking cycle, and of course this has been the most aggressive one on the upside in about 40 years, you get a significantly inverted yield curve like we have gotten. It doesn't immediately start to crimp lending, but even before Silicon Valley Bank failing in March, the Fed's SLOOS, senior loan officer opinion survey showed that credit conditions had tightened into recession territory. So given the old line of credit is the lifeblood of an economy, as it starts to feed through with long and variable lags, it ultimately does start to crimp economic growth via that investment cycle. We haven't seen it in earnest yet, but to suggest that this time is different and we're not going to is probably too complacent an assumption.
There's also, I think, Chris, a question of supply demand. Is it a matter of there's not the credit to extend, or is there the demand for the credit? Are there businesses asking to borrow as much as they were before?
Yeah, so I think that is a question, and also it's both demand side. So when you look at just the overall, like particularly within commercial real estate, and you look at volumes in terms of origination, that's fallen down substantially. I mean, you're looking at year-over-year numbers close to 60%. But I think the more interesting question that we're getting a lot from our investors is actually when you look at these sectors that have lagged, are they a buy at these levels? For financials, I would say go in the direction of preferreds, which is really a play on the balance sheet as opposed to the equity, which could be challenged from some of these profitability considerations.
So interesting. Thank you so much, Chris. That's Kristin Bitterly of Citi and Liz Ann Sonders of Charles Schwab. Always great to have them with us. Coming up, the business of college football got all shook up when 4 more Pac-12 schools jumped ship for the Big Ten. We talk with sports investor George Pyne of Bruin Capital about where it all leads. That's coming up next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. The world of college football continues to reinvent itself as this week 4 more schools, USC, UCLA, Washington, and Oregon, left the Pac-12 conference to join the Big Ten, rounding that 10 number up to an even 18. To explain what's going on, welcome now George Pyne, founder and CEO of Bruin Capital, who invests in sports and earlier served as a sports agent for IMG. So really great to have you, George. I think you were not just an agent. Didn't you create the college sports section for IMG?
Yeah, I was actually president of IMG and led our investment into college sports, which was a good one.
So you're the man to talk to about this. I must say I'm just, I cannot believe what's going on with college football. Where does this all end? Are we going to end up with 2 super conferences or 3 super conferences?
I don't know. You do feel more pressure for consolidation. I think what's unusual, first of all, college football is the #2 sport in America. And it's a big business, it's a multifaceted, and it's run by a very fragmented industry. And so it's a bit unwieldy. And I think what you see is that the suppliers, the TV networks, have a bigger say because of the fragmentation and the lack of really a unified vision or leadership in college sports. So therefore, it's a little bit of the Wild West.
We'll start exactly there. Who is running it? Is it college presidents? Is it athletic directors? Is it the television providers? Is it the Congress? Who's running it at this point?
It's really the college presidents of the individual universities. But as you've seen, they're not always loyal either. USC, UCLA leaving the Pac-12, a conference that had been around since 1915, right? And so it's very fragmented and self-interested. There isn't a unifying group that looks out for college sports and has the ability to lead college football.
What's going on with streaming? I mean, we see this with ESPN right now, ESPN Plus. We've just had earnings come out of Disney. That seems to be changing sports. Back in the old days when I was involved with ESPN, you knew how much money was coming up because of those basic cable deals. Those seem to be going away. How's that going to change the business?
Well, it's in transition, but what you see really, a lot of the leagues today have tied their rights up long-term to linear television. So the money's in linear television, but the new viewers and new consumers are in streaming. And also, as you point out, the margins are quite different between linear and the cable bundle than they might be for streaming. So it's going to be a 10 to 15 year transition, and we're at the early days of that. I think you'll see in the NBA, they'll do a streaming deal as part of their national package, I think to help mitigate some of the challenges that cord cutting is creating for regional sports networks. So I think it'll be a transition, an evolution, not a revolution.
Is college football going to learn something from the NFL? I mean, Roger Goodell seems to have been pretty masterful at adding some of the streaming services and not losing the basic cable and other television rights, and just keeps adding the revenue, it seems like.
Yeah, I do think you're going to see it. You haven't really seen any major conference yet do a streaming deal. I mean, I think you'll see games on ESPN+, you'll probably see games on Peacock, but you haven't seen Apple or Amazon invest yet, but I think it'll come eventually.
Wasn't Apple really flirting with the Pac-12, in fact?
They were flirting with the Pac-12, put in a meaningful offer, but in the end, it couldn't match the linear opportunities that those schools had at the other conferences.
The Pac-12, and who knows what's going to remain of the Pac-12 at this point. Pac-12 had a streaming strategy, as I understand it. They were really going to go into streaming. It didn't work out for them. What went wrong there?
Well, I think that just the stability of the league, I think the schools felt more comfortable with the money and stability that the linear television package offered versus the instability and the less dollars that the streamers provided. And I think there was some disagreement between certain schools, but at the end of the day, I think people opted for stability and more money from the linear television.
What about the athletes themselves? There's been a lot of question about whether they should get paid. We now have the name, image, likeness phenomenon going on, so I guess they can get some licensing money. But are we going to start paying our college players?
I think that's the big question, David. I think the courts are going to be looking at that in the next 5 or so years. What is the definition of an employee? Do the student athletes meet that definition? The courts historically have been very deferential to the college model, and that's changing. So most of the most recent rulings have actually favored the athletes being paid. And where I see this going, unless somebody steps in, is that the athletes are going to be bargaining collectively like they do in the other leagues, not just for money, but also work conditions. Again, college football, bigger than the NBA, bigger than Major League Baseball. Those athletes are being paid a lot of money. These athletes are not being paid any money. I don't think it's a revolution. I hope it's an evolution, a modernization of the game, much in the way the Olympics modernized. You know, before you didn't have pro athletes in the Olympics, today you do. People still love the Olympics. I think you're going to have to modernize. College football is generating anywhere from $5 to $7 billion a year. It's hard to conceive that the participants in those games are not participating in a more meaningful way financially.
Huge business for all the reasons you just described. Are there going to be investment opportunities? We've seen in professional sports teams, as we've gotten private equity interested in it, we even have some sovereign wealth funds who are saying they'd like to participate. We'll see how far that goes. But it's turned into an investment, not just something that a rich person buys as an ego thing. Is there a potential somehow for private equity, sovereign wealth funds, other investors to get involved in college football?
There could be. I mean, you're hearing today from Florida State that's hired J.P. Morgan to look at different investment opportunities for more non-traditional investors. So maybe that might be the beginning of that. I don't know. It's unclear at the moment.
You know this sport. You love this sport. Are all these developments, do you think, going to be good for the sport? And by the way, good for me as the viewer of my Michigan football team.
Yeah, you know, change is inevitable in life, so you have to adapt to change. I would love to see the change come from within the industry. I'd love to see the industry coalesce and lead the change, because they're the most knowledgeable people to lead it. My fear is that the courts, just like with the NIL, are going to lead it, because the industry won't be able to have a consensus. So my hope is that the industry leads the change and not the courts, but I'm very concerned that the courts will lead the change.
George, great to have on Wall Street Week. Thank you so much for being here. That's George Pyne of Bruin Capital. Coming up, as China struggles to get going again, the U.S. added more restrictions on investment in the Middle Kingdom. We talk with Deborah Lehr of the Paulson Institute on prospects for the second largest economy in the world.
The world has really been very focused, I think, on how to deal with a strong China, and now we haven't really thought through some of the implications of a weak China.
That's next on Wall Street Week on Bloomberg. China. Its economy has grown faster than any in the history of the world and is either number one or number two to the United States, depending on how you measure it, according to Graham Allison of Harvard.
China is not just a rising power. China has risen. China is now seriously rivaling the U.S. in virtually every domain.
But despite all the progress made, there are questions about whether China can continue its economic miracle, at least at the same pace. Economic numbers have been coming in weaker than expected.
We're not going to see China go back to where it was. It's a very big component of the global economy.
Raising some doubts from Michelle Lamb of Societe Generale about whether China can grow at the 5% pace it's set for itself this year.
There's downside risk, and I think that primarily comes from the property sector.
And hopes of government stimulus to keep things going are not as bright as they might have been because of all that debt.
Talking about China's debt situation, I think it's a long-standing structural issue, and it's no surprise that China is facing a very big debt problem. And that's precisely one of the reasons we don't see very aggressive stimulus coming from China.
On top of all the internal issues, China also confronts a United States imposing new restrictions on trade and investment, whether it's export controls on shipments of technology to China, or those limits on outbound investment into China President Biden announced this week.
The goal of this executive order is to make sure that we're limiting the ability of financial flows and the know-how that often goes alongside those financial flows to give countries of concern the ability to get around the things that we're trying to prevent them from getting access to, like the most advanced semiconductors.
Leaving investors to grapple with what to do and not do with an economy simply too big to ignore.
You can't rule out China. Since I started to go to China, 1984, per capita income increased by 28 times. It's a power, and it's a smart power.
And to take us through where we are with China right now, we turn to our non-resident expert here at Wall Street Week on China. She's Deborah Lehr. She is vice chair of the Paulson Institute, as well as being CEO of Edelman Global Advisory. Deborah, great to have you back on. It always is. We are hearing a lot coming out of China right now. We had numbers this week which were not very encouraging, perhaps some deflation going on. Certainly their trade is down. What is your sense of what's happening? What are the important things we should be looking at in China right now?
Well, so nice to see you again, David. And definitely Xi Jinping has a lot on his plate. The world has really been very focused, I think, on how to deal with a strong China. And now we haven't really thought through some of the implications of a weak China. When we look at what is happening in the real estate market, there are still major challenges ahead. And this is critically important because it's one of the main sources of investment for most Chinese. And so if the market is not doing well there, it has a significant impact on growth and investment opportunities. 2, local debt. This is something that policymakers have been tracking for a long time, and COVID just made it worse. A lot of this debt, and this is what's really concerning, is off the books, and so it's very hard to even track and be aware of. And it relates to how the center is dealing with and forcing a lot of these local governments to take on unfunded mandates, and their main source of revenue previously was from the real estate market. And so if they haven't had access to revenues coming from the sales of real estate, they have to look for other sources. It's a big concern, enough for Xi Jinping to be sending down policy enforcement teams, which you would think after all this time in office he wouldn't have to do anymore. But it shows the concern that they have with local officials and their willingness to actually follow mandates coming from Beijing. And then to top that, you have weakness in the local banks, which again are lending to the local governments and to the local real estate market. Top that with youth unemployment. For many in China, this is the source of their retirement plan, the fact that their children are going to be working and supporting the parents and the grandparents. And the numbers are over 20%. The unofficial numbers are believed to be significantly higher than that. And it creates a real lack of confidence domestically in China and in Xi Jinping's economic policies. Top this with the fact that there's a slowing global economy, meaning that China's export opportunities continue to be hit, and they're down 15%, and changing geopolitics, making it more complicated for companies to be doing business in China, and Xi Jinping really has some rough waters ahead.
Is President Xi at this point solving this problem for the economics of it, or is he solving it for the ideology of it? Because some of his rhetoric has indicated he actually may care more about the party and the party rigor in the private sector than he cares about the economics of it.
Well, that's an excellent question. He certainly has been very focused on using the party as the means to govern, whether it's through the government itself, whether it's through the military, whether it's through the judiciary. It's the party that's supreme. And he has tried to create an ideology and a unity through that. We see in the new structuring of the government that it's all the party committees who are actually setting economic policy, and the government more and more is just an implementer. So as we see these difficulties in the government, these weaknesses in the ability to create jobs for the youth, in the challenges in attracting direct foreign investment or venture capital or private equity, the big question will be whether Xi Jinping pivots and focuses more on market opening and creating the confidence and the conditions to continue to attract foreign business, which is necessary if he's going to continue to grow his economy. He can't do it without foreign business being present. We've seen him pivot before. We saw how quickly he was willing to pivot at the end of COVID in opening up to the rest of the world, and we're starting to see signs that he's beginning to reconsider some of his economic policies to be more open and change that emphasis from such a focus on the party, not that it's ever going to go away, but to really be focused more on providing opportunities. Look at what he's been doing in technology and the opportunities now in encouraging platform companies and the tech executives to be innovative, where it wasn't that long ago when they were one of the top targets.
President Xi may decide that he wants to be more open to the rest of the world. Is the rest of the world open to President Xi at this point? Certainly the United States and the West seems to be taking some actions, including this week with the restrictions on outbound investment into China. We see various actions being taken. To what extent does that hamper what President Xi can do? As you know so well, Deborah, foreign direct investment is down rather substantially into China.
It is, and I think one of the biggest questions is around confidence in China and its leadership. Obviously, the United States has to stay very focused on its national security, and these outbound investment regulations are limited to areas that it's concerned that we might be creating competitors to our own national security interests. I think it's going to be important to watch if other countries do the same. There definitely is a reconsideration in Western economies in looking at what their relationship is economically with China. It's not to say that companies aren't investing there and continuing to do business there, but more and more we hear they're looking at China for China, and then they're looking at the rest of the world. Some of China's own policies, including its national security law, are really emphasizing that fact because it's a very murky area, particularly when it comes to issues like data. And more companies are looking at how they can create an island in China for data and not have it linked into the rest of the world. And those issues, even though they may sound small right now, start to have a ripple effect in how CEOs and others are making their investment decisions. And this is one of the reasons. It's not just these geopolitical restrictions that we're seeing that are limiting direct foreign investment in China. It's some of China's own policies that are causing a concern within, I think, the foreign business community.
Deborah, it's always a pleasure, really a treat to have you with us. That's Deborah Lehr. She's the CEO of Edelman Global Advisory. Coming up, it looks like we may not get that recession after all. What does that do for all our investing plans based on worst-case scenarios? We'll ask Rick Rieder of BlackRock.
My base case is that inflation is moderating. Those real rates we talked about should come down with a Fed that is now stable and will start cutting rates. So I think the equity market next year will get a nice boost from what I think will be a reduction in the interest rate.
That's next on Wall Street Week on Bloomberg.
That is definitely not the Fed's intent, and has not been the Fed's intent throughout this expansion. We raised interest rates in 94.5 without the intent of causing a recession, for sure, and we didn't. And the Fed is trying to do a duplicate of that soft landing now, not to cause a recession.
That was former Fed Vice Chair Alan Blinder on Wall Street Week back in January of 2000, a little more than a year before the U.S. went into a recession following a series of rate hikes. But that was then, and this is now. To bring us up to date on whether the current interest rate policy is likely to give us a similar recession, we welcome back Rick Rieder. He's BlackRock's CIO for Global Fixed Income and head of its Global Allocation Investment Team. Rick, great to have you back on Wall Street Week.
Thanks for having me. It's great.
So where are we right now? Not too long ago, a lot of economists, including Fed economists, as well as Bank of America, others were saying we're going to have a recession. They've all changed their mind. Where are you?
So I think, and I did a presentation a while ago, I called the U.S. economy the polyurethane economy because of how resilient it is, like one of those Tempur-Pedic mattresses, how resilient it is, that it's very hard to dent it. And you think about, I mean, the economy today versus 20 years ago, 70% consumption, 70% services. Think about, to create a recession, if you're 70% services, which are amazingly stable, they don't go into recession, your goods part of your economy, which is now a fraction of the economy, has to really become devastated. The other side of it that I think people misinterpret, U.S. economy is not as interest rate sensitive as it was 20, 30 years ago. People have locked in their mortgages already. The banking system runs differently. Commercial real estate gets hurt. Companies have termed out their debt. They don't rely on the front end of the yield curve like they used to, the Fed funds rate. And then the last point is the big spenders on CapEx in the U.S. economy are companies, tech companies. They're not big borrowers. So I think people overestimate when the Fed raises rates this much, you hurt parts of the economy, the regional banks, the small banks, your commercial real estate, but the rest of the economy is amazingly resilient to it.
So it's fascinating, Rick. I guess the answer to the question of why so many people got it wrong is they had the wrong model. Do we have to revise our economic models going forward for the reasons you just identified? It's a different economy than it was 20 years ago.
100%. By the way, not only a different economy today, so we try and model and project what inflation is going to look like 2-3 years hence, let alone for the next year. Think about now how the economy is evolving around AI and productivity and how jobs are going to evolve. Very hard to think about economies. People look at the analog from 10 years ago, 20 years ago, and what happens when rates move. I think you have to look, I mean, we're trying to spend more time on is environmental conditions that you're operating within and what impacts it. Another way, you talk about we have a need for more people. The unemployment rate sits at 3.5% is a structural reason. You look at, and we've talked about on your show a bunch of times, you look at the number of people hired for healthcare, education, not interest rate sensitive. There's a shortage, leisure, hospitality, hotels, restaurants. There's a shortage of people. When you have a 3.5% unemployment rate, because it's structural, it's pretty hard for the economy, at good wages, pretty hard for the economy to go into a deep recession when so much of the economy is consumption.
So let's take a look at the investment profile, given what you've just said. Where does the 10-year want to be? Because so many investment decisions are really keyed off of where the 10-year yield is. Where does it want to be right now? Because I hear people saying in the mid-3s, low 3s. I hear people saying in the mid-4s.
So, I think, around 4%, I think is a reasonable resting place. My sense is there's a couple of factors that work against one another. The first one is Treasury is issuing an amazing amount of supply. We're going through the issuance, and the Treasury just announced they're going to increase the supply longer on the curve. They relied on immense amounts of Treasury bills. You're seeing this almost $300 billion a week gross supply, not net, but gross supply of Treasury bills. So you're going to get more supply. So that tends to push rates a bit higher. However, inflation is coming down. You look at the CPI data, and I was looking at the 3-month moving average of core CPI. If you strip out some of this funky used car stuff, is only 1%. So now you take it's actually 1.1%, 3-month moving average. So you say, okay, 10-year note now, the real rate net of inflation, it's not bad. I mean, the level on 10 years. So I don't think we're going very far. I think the supply could push 10 years a bit higher. If you said to me where are we going to be 6 months from now, 9 months from now, a year from now, I think the 10 years is going to migrate lower, because if you believe that inflation is coming down, which I think is right, then the 10 years should start to move closer to 3.25. And I think we'll see that next year. But, for the next couple of months, it's sticky at these levels.
We had so many debates about hard landing, soft landing, what kind of landing. You suggested maybe we may not have a landing at all.
Yeah.
So given that, does that change your investment outlook right now? Does it change how you invest your money?
So I got to say one thing about it. I mean, I think the economy is moderating from extraordinary 12.3% nominal GDP in 21, 7 and change percent in 22. That is unbelievable. I'm not saying we can't slow a bit. And, even could you have a technical recession? I just think you'd have to wake people up and tell them, because you're operating at such a high level in the economy. So how do we think about it? Listen, I think there are a lot of equities that make sense today. The equity market's had a really good run. 7 stocks, 8 stocks have driven it. There are a lot of companies. If you believe the economy is stable, you can buy a lot of businesses that trade at 3, 4, 5 times cash flow. If you believe the economy is stable, autos, airlines, home builders, some of the energy infrastructure trade at pretty low multiples. So I like owning the equity market, so I like running portfolios. I think you have upside in equities, and then you can create amazing amounts of carry. The front end, I talk about the front end of the yield curve, you can buy commercial paper buying 6%. If you can create a 6 and then own some equity, and by the way, it gets to your point about do I need to own a lot of 10-year or 30-year treasuries, that at 4, like, I don't know, not that interesting, but I can buy a lot of front end, a lot of yield, and then buy some equity, and so get some upside with some real income.
On the equity front, talk about the discount rate, because we're up now north of 5, right?
Yeah.
Some people think it's going to come back down next year fairly quickly. Other people think it may stay up there. That really affects the value of those equities and the valuations you're talking about, doesn't it?
100%. And so, by the way, my base case is that inflation is moderating. Those real rates we talked about should come down with a Fed that is now stable and will start cutting rates. So I think the equity market next year will get a nice boost from what I think will be a reduction in the interest rate. By the way, credit spreads are also really tight. Companies don't borrow off. They borrow off of their spread to treasuries, and they're pretty tight. So the discount rate is not bad today for equities, but it is, my sense is it's going to come down from here.
So you were anticipating Fed cutting rates next year.
Yeah.
I mean, how early and how much?
I mean, I think the Fed would like to stay on hold for a period of time. But I think as you get into the second half of the year, then and maybe earlier if inflation decelerates quicker, can you start to do 25s a meeting? I think so. I think these restrictive rates, my sense is, I would talk about your show a lot. They're because the economy is not as interest rate sensitive as it used to be. Those restrictive interest rates really hurt small banks. They really hurt commercial real estate. They hurt targeted parts of the economy, which quite frankly I think have been overdone. And the other thing they really hurt is the U.S. government is running over $30 trillion of debt. The Treasury has usually borrowed its Treasury bills at 0, with a huge part of their borrowing scheme is at 0. Now it's at 5.5%. The debt service in this country will choke the amount of fiscal spend that we can have in the country. The Fed needs to bring the rate down so that we don't create too onerous a problem in terms of debt service in the country.
Since we last got to talk to you on Wall Street Week, you've got a new gig. It's an ETF.
Yeah.
Tell us about the ETF and why you're doing it. What's the itch that you're trying to scratch that hasn't been scratched?
So there is, the explosion of ETFs. People use them in so many different ways. You can trade them all day. They're tax efficient in many ways. People like to put them in models. They say, I've got this ETF, they buy and sell. Anyway, so we've been asked to do an active ETF, and so there's been a tremendous growth of passive ETFs, both in credit, in rates, et cetera. And now you're seeing more people want active. So in fixed income, most managers outperform indices consistently over time for a variety of reasons. There's 68,000 fixed income securities. Compare that to the S&P 500. There's so many tools we have, and so people have asked for, gosh, I'd love to get the exposure in an ETF form. Give me something that can get me a little bit more juice. And so in this new one we're doing called BINC, it's a 7% yield. We manage, sometimes we're in securitized assets, sometimes we're in high yield. We move it around tactically, investment grade credit. And to get that sort of yield and have somebody, it's hard as an individual to buy securitized assets. You can buy CLOs or commercial mortgages. To many people, like evaluating the collateral is hard. And so, we've been doing it for a million years. And so anyway, it's becoming really attractive, and there's a lot of excitement around it.
So Rick, explain the mechanics of this. We hear so much about private credit and the growth of private credit. How does something like your ETF interact with the big private credit guys?
Wow, that's a great question. So private credit today, you think about how the world has evolved. We talk about carry and we talk about income you can get today. Private credit now, versus private equity. Private equity is hard because you can't, with rates where they are, with the public market rates, because we can create a 7 in liquid markets. We talk about through this ETF. Now private credit's got a price behind that. And by the way, private credit incorporates also real estate financing, et cetera. You can get private credit at 10, 11, 12% with real collateral, real covenants, and create a really nice structure. So I think private credit's going to grow the next few years. Harder for private equity when you have to finance at 12 than when you financed at mid single digits, mid to high single digits. So I know it's a really big deal. I think private credit will be, you'll see a lot of people, buy things like, the ETF where you can come in and out of it, get some real yield, and then also say, private credit, I'm going to own that for 3 years, 5 years longer.
Okay, Rick, it's always such a treat to have you on Wall Street. Thanks you so much. That is Rick Rieder of BlackRock. Coming up, a dollar doesn't buy what it used to. We go through a list of how much things cost these days, from sports teams to UPS drivers to a reservation at Rayo's. That's next on Wall Street Week on Bloomberg. Finally, one more thought. Money may not buy you happiness, but at this point, what can it buy you? The CPI this week confirmed that inflation is slowing in the United States, but it's still pretty high, which got us wondering what money can still buy you in this time of higher prices. We learned this week that it can't buy you a 5th world championship in women's soccer, or football, as the rest of the world calls it, when the U.S. team lost to Sweden, but will still get a pay raise because of its agreement to split the pot with the men.
Women's World Cup is performing quite well. We're starting to see increasing traction, double-digit traction, as the tournament progresses.
Enough money will buy you an NFL team, but the price is going up, with estimates out this week saying it would take a cool $9.2 billion to get the Dallas Cowboys. That's if Jerry Jones were willing to sell it. And that's despite the fact that they haven't won a Super Bowl since 1996. We also learned that enough money, about $170,000, including benefits, can buy you a UPS driver for a year under the new contract with the Teamsters, though it may be coming out of the pockets of UPS shareholders.
The difference is that UPS has been negotiating this contract, which has been a big overhang. The cost inflation from the contract in year one is quite high. We're estimating mid-high single digits, whereas FedEx is now transitioning to more of a restructuring of their ground and express businesses, and their costs are moving the other way around.
About $2,000 or $3,000 will buy you a quiet luxury coat from Norwegian wool, so you can look just like one of the Roy family on Succession.
So when you talk about quiet luxury, I don't think that's anything all that new. I think most of us and most people in the audience who really have their own story to tell, they want their brand to be the one that's being worn, not another company's brand.
For something between $2 and $25 million, you can get a luxury condo at the Cortland in West Chelsea in Manhattan, and they will throw in not one, but 2 pools, one for swimming laps and one for just splashing around. No amount of money will get you a reservation at exclusive New York Italian restaurant Rayo's. For that, you need to be one of the regulars who own their own tables pretty much really in perpetuity. But if you can't get someone to take you as their guest, you can always just buy a jar of Rayo's tasty pasta sauce to enjoy at home. And Campbell's Soup this week agreed to pay $2.7 billion for the privilege of bringing you that Rayo's sauce. And this year, Steve Cohen is proving there is one more thing you cannot buy, no matter how much you're willing to pay: a championship baseball team, as his record-breaking spending on the New York Mets has taken him and his team nowhere fast.
Free agency is really expensive. Okay, if you want to field a good team from free agency, that's what it costs. If you want to field, fill all the positions with hopefully quality players. Okay, and sometimes you can get it right, and sometimes, things go wrong.
I'll say so. That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.